Warren Buffett once said, "If you don't find a way to make money while you sleep, you will work until you die." One of the main reasons people choose the dividend income investing strategy is because of income consistency and predictability without active participation. Even though the markets might be difficult at times, they will feel comfortable knowing that some dividend payments are about to be made to cover their basic expenses. We have heard lots of stories of individuals who achieve financial success in the market, even without relying on dividends. Frequently, heated discussions emerge online about the best investment strategy, but it's crucial to acknowledge that there is no one-size-fits-all solution. The United States stock market has consistently yielded substantial wealth over time, offering numerous ways to harness its potential. The passive income investing strategy will be suitable for you if it resonates with your rationality and your expectation. As you navigate the investment journey, there will likely be periods of challenges. It is crucial to have the confidence and conviction to stick to your chosen strategy. You can effectively implement and consistently execute the strategy. Because regardless of the brilliance of a strategy, its effectiveness is diminished without the necessary willingness and knowledge to execute it consistently. It aligns with your goals. If you find great satisfaction and relief from financial stress through a reliable cash flow from a high-yield dividend income portfolio, and if you can sleep well at night regardless of market fluctuations, then the passive income investing strategy may be a good fit for you. The fundamental purpose of passive income investing is to offer a high level of immediate income. Your objective is to find stocks that will begin producing dividends immediately. You are not interested in promises of future profits, you want to realize those gains right away. Let's look at some of the key points of the passive income investing strategy you should know.
When you learn as an investor over multiple decades is the only thing that matters is free cash flow. That's it. There is no other reason to own a stock. And with that philosophy, it brings you into a place where you focus on a company's ability to generate incremental cash flow, because just owning a dividend-paying stock is not good enough. Because, let's say we find a stock today that's paying a 3% dividend yield, and tomorrow, because its forecast for sales get cut in half, the stock drops by 50%. Now it's yielding 6%. I don't want to own that stock either.
Cash is king. Let's take a look at the financial information that companies normally show in their report. Cash flow is crucial to look at. Imagine your own budget and cash flow. You monitor how much money comes in as income and goes out as expenses. For a company to pay you a regular income, they need to earn enough and save enough cash after expenses. Free cash flow, FCF, is the cash flow left after all cash expenses, including the money for keeping their assets, capital expenditure, and excluding any non-cash items. Some midstream oil and gas companies often report free cash flow figures in their annual report. Or you can easily find such information on the internet. The more cash the company keeps after all their payments, especially after they've paid their dividends to you, the better.
Number two, diversification really matters. So I never want to own more than 5% in any one name, and you know that really works when you go through periods like 08, 09, where you have volatility in sectors.
Value of diversification: when you rely solely on your employment for income, you face the risk of losing everything if you lose your job. Finding a new job may not always be a quick or guaranteed solution. However, by drawing income from your investment portfolio, you gain control over your financial stability. With multiple income sources, 20, 40, or even more, the impact of one source drying up becomes less significant. Imagine having the security of 40 different jobs to fall back on when you faced a layoff. Each stock you own represents another income source, and the more stocks you have, the lower the risk of company-specific issues affecting your portfolio. Accumulating more income streams should always be your goal. The more sources you have, the less impact it will have if one stops paying dividends. Diversification is not only a way to mitigate potential risks but also an opportunity to enhance your portfolio. Let's take the popular ETF, SCHD, as an example. It is widely favored by retirees seeking passive income. While SCHD boasts an impressive track record and is considered one of the best passive income ETFs in the market, its dividend yield is relatively low at 3.58%. This is notable considering that most retirees aim for a 5% or 6% retirement strategy, especially with the current federal funds rate exceeding 5%. To supplement SCHD, one could consider adding covered call ETFs like QYLD, XYLD, JEPI, and so on. Additionally, SCHD lacks exposure to inflation-protected sectors such as energy and real estate. It also falls short in providing exposure to high-yield and defensive sectors like communications, utilities, and senior secured floating-rate corporate debt. By investing in SCHD and complementing it with stocks or ETFs from the mentioned sectors, investors can construct a well-diversified income portfolio, which offers a rich, rewarding, and relatively secure retirement. Furthermore, the yield from this portfolio can easily surpass 5% or 6%, while maintaining consistent and above-inflation dividend growth. A high yield does not mean high risk. Some people think that investing in stocks with yields over 6 or 7% is too risky. They say the high yield is a sign of danger, and that low yield means safety. But that's not always true. Look at what happened in 2023. Many companies that had low yields cut their dividends by a lot. VF Corporation, VFC, chopped its dividend by 40%. Paramount Global, PARA, saw its dividend drop by almost 80%. Intel Corporation, INTC, which had raised its dividend for 20 years, slashed it by 65%. From the dividend history, we can find out, all these companies had relatively low dividend yields in the past 15 years. The so-called safe investments like U.S. Treasury bonds lost a lot of value in the past 3 years. The falling prices of these bonds caused some banks to fail this year. You can't determine an investment by its yield alone. All investments have some risk. You have to look at the fundamentals, the cash flow, and the growth prospects of each company. Don't let the high-yield myths scare you away from some great opportunities.
You need the right orientation. 90% of the people, I'm pulling a figure out of the air, but 90% of the people that buy stocks don't think of them the right way. They think about something that they hope goes up next week. And they think about the market as something they hope goes up. And if it's down, they feel worse. I feel better.
And you think about?
Pardon me?
And what do you think about?
I think about what the company's going to be worth 10 or 20 years from now. And I hope it goes down when I buy it, because I'll buy more.
Be ready for the long haul. Imagine holding an investment forever, or at least until something major changes. Don't care about the next 2 to 3 years, care about the long haul. Sometimes things happen that make people sell and move on. But most of the time, don't let short-term price swings bother you. They're just noise. Think about your job. You work hard and get paid every month, right? Well, your dividend income portfolio is like another job. You invest once and get paid every month or every quarter, as long as you hold on. And the best part is, they won't fire you unless you quit. There's something powerful about getting regular dividend income. It makes you feel good and confident. It helps you stick with your investments even when they go down in value. Time is your friend because it gives you a chance to recover from market dips and to collect more dividends along the way. When you're tempted to make a rash decision based on fear or emotion, remember that time and income are on your side. We appreciate your watching. Please hit the like button below if this video helped you in any way, and don't forget to subscribe to the channel. Thanks again and see you next time.